Most people will never be rich. And it's not because they don't work hard enough. It's not because they lack intelligence or opportunity. It's because they fundamentally misunderstand how wealth is actually created. They think the rich get richer by being smarter stock pickers, by timing markets perfectly, or by grinding harder than everyone else. But here's the truth that separates billionaires from everyone else. The richest people don't gamble. They don't chase trends. They don't hope for the best. They bet on what must happen. And today, I'm going to show you exactly how they do it. This is William Vanderbilt, and welcome to Premium Wealth Insights. Before we dive deep into the strategies that built empires worth hundreds of billions, I need you to understand something. This is a brand new channel, and we're building a community of serious wealth builders. We're on a mission to hit 100 subscribers, and I need your help. If you're committed to understanding how real wealth is created, hit that subscribe button right now. We're aiming for 50 likes on this video because I want to know there are 50 people out there ready to think differently about money. And drop a comment telling me where you're watching from. I want to know where in the world this message is reaching. Because what I'm about to share isn't theory. It's the blueprint the ultra-wealthy have used to build generational fortunes. And if you're not subscribed, you're going to miss the strategies I'm dropping in the videos ahead. Let me tell you about a moment that changed everything for one of the greatest investors who ever lived. It's 1967. Warren Buffett is 37 years old, and he's about to make a decision that will compound into over $600 billion in wealth. He's looking at a struggling textile company called Berkshire Hathaway, and everyone around him thinks he's insane. The textile business is dying. Competition from overseas is crushing margins. Any rational person would walk away. But Buffett sees something no one else sees. He's not looking at the textile business, he's looking at the insurance subsidiaries. And in those insurance companies, he sees something extraordinary. He sees an inevitable. Here's what Buffett understood that changed his life and the lives of everyone who followed him. Insurance companies collect premiums from customers today, but they don't pay out claims until months or years later. That gap creates something magical called float. It's money that belongs to policyholders, but it sits in the insurance company's bank account, earning returns, being invested, compounding. And as long as the insurance company maintains disciplined underwriting, that float costs almost nothing. In some years, it costs less than zero because premiums exceed claims. Buffett realized this wasn't a competitive advantage that could be copied or disrupted. This was a structural advantage that flowed from the nature of insurance itself. It was inevitable that as long as people needed insurance, this float would exist. It was inevitable that as the economy grew, this float would grow. It was inevitable that proper investment of this float would compound over decades into extraordinary wealth. In 1967, Berkshire Hathaway had $7 million in float. By 2023, that float had grown to $169 billion. Not because Buffett was a better insurance salesman than his competitors, not because he worked harder, but because he positioned himself in front of an inevitable and had the discipline to wait while compounding did its work. From 1965 to 2022, Berkshire Hathaway generated an annualized return of 19.8%. The S&P 500 over that same period? 9.9%. That gap is the difference between betting on inevitables and betting on everything else. That gap is the difference between generational wealth and comfortable retirement. Now, let me be crystal clear about what an inevitable actually is, because this is where most investors go wrong. An inevitable is not a hot stock. It's not a trend that might happen. It's not a company that could win. An inevitable is a structural, long-term trend, so powerful that no economy, no policy, no market downturn can stop it. It's a change in human behavior, societal structure, or technological necessity so profound that betting against it is betting against human nature itself. And here's the key. Unlike cyclical opportunities that boom and bust, inevitables compound silently, relentlessly, and predictably over decades. Peter Thiel, the co-founder of PayPal and Palantir, has built multiple billion-dollar fortunes on this exact principle. He wrote that competition is for losers. Think about that. The conventional wisdom says you need to outcompete everyone else to win. Thiel says that's exactly backward. When you're fighting in a saturated market, competing on price, competing on features, competing on marketing, you're destroying value. You're in a race to the bottom. But when you position yourself at the intersection of inevitables, you don't need to outcompete anyone. The tide lifts all boats, and early positioning compounds to extraordinary advantage. You're not fighting for a slice of a fixed pie. You're riding a wave that grows the entire ocean. Charlie Munger, Warren Buffett's partner for over 5 decades, said it perfectly. The big money is not in the buying or selling, but in the waiting. Most people cannot grasp this. They think wealth comes from being active, from constantly moving, from finding the next hot opportunity. But the greatest fortunes in history were built by people who identified an inevitable, positioned themselves correctly, and then did nothing except wait while compounding, worked its magic over decades. That's the secret. Patience combined with positioning. Discipline combined with inevitability. So what are the inevitables? What are the trends so powerful that they will reshape the global economy over the next 20, 30, 50 years? Let me walk you through the 5 major inevitables that are creating trillions of dollars in wealth right now, and how the ultra-wealthy are positioning themselves to capture that wealth. The first inevitable is one that cannot be stopped by any force on Earth. Aging populations and the healthcare revolution. Here are the numbers, and these numbers represent mathematical certainty. The global population aged 60 and over is expected to double by 2050. By 2030, Americans aged 75 and older will represent 10% of the population. This is not a prediction that might happen. This is demographic destiny. These people are already alive. This trend cannot be reversed unless there is a catastrophic population event, and even then, the trajectory is set for decades. Now here's why this matters for wealth building. This aging wave creates irresistible demand across multiple sectors: elder care services, pharmaceuticals, healthcare technology, telemedicine, medical devices, senior living infrastructure, financial planning services for retirees. These are not optional services. These are necessities. An aging person needs healthcare. They need medication. They need assistance. They need financial planning. The demand is guaranteed. Companies positioned in these sectors don't need to beat competitors. They simply need to serve an expanding customer base with no alternative buyers. The Gates Foundation recognized this inevitable early and pledged $200 billion over 20 years to improve health outcomes globally, with particular focus on aging-related diseases and innovations powered by artificial intelligence. And here's the return on that investment. Every dollar invested in global health over 18 years has generated $20 in returns. Compare that to $1.19 for the S&P 500. This is not exceptional stock picking. This is simply riding an inevitable. An investor who recognized aging as an inevitable in 1990 and invested in healthcare companies, pharmaceuticals, and elder care providers would have compounded wealth for 3 decades with tailwinds that never stopped. Every single year, the customer base grew. Every single year, demand increased. Every single year, revenue compounded. If you're serious about building wealth and you're not thinking about how to position yourself in front of demographic inevitables, you're leaving generational money on the table. And if you want to learn the other sectors where this same principle applies, make sure you're subscribed, because I'm breaking down sector-specific strategies in upcoming videos. The second inevitable is the collision of an aging workforce with technological advancement, and it creates something unstoppable: automation and robotics. Here's the reality. Countries experiencing rapid aging have adopted robotics faster than anywhere else on Earth. Why? Not as a policy choice, as an economic necessity. Without robots, labor-short economies cannot maintain productivity. It's that simple. You either automate or you collapse. That's not hyperbole. That's mathematics. China recognized this inevitable and is investing 1 trillion yuan, that's $138 billion, over 20 years in robotics and AI. They've established a national strategy that treats automation not as optional, but as essential infrastructure. Elon Musk is betting that Tesla's future value derives 80% from its Optimus humanoid robots. He's estimating a market for 20 billion such robots globally. That's more than twice the number of smartphones on Earth. He predicts the robot market alone could reach $30 trillion in annual revenue. Now you might think Musk is exaggerating. Maybe he is. But even if he's off by 50%, we're still talking about a $15 trillion market. Even if he's off by 75%, we're still talking about a market larger than the entire current global automotive industry. But here's where it gets interesting. Let's talk about NVIDIA. In the early 2010s, NVIDIA made a bet that would transform the company from a gaming chip manufacturer into one of the most valuable companies on Earth. They recognized that deep learning, the foundation of artificial intelligence, would require GPUs, graphics processing units designed for parallel computation. But recognizing the trend wasn't enough. NVIDIA did something brilliant. They invested billions in creating CUDA, a software ecosystem that locked developers into NVIDIA's platform. By the time AI exploded, every major AI researcher, every tech company, every startup building AI models was using CUDA. Switching away from NVIDIA would require rewriting entire software stacks and retraining entire teams. The switching cost became so high that NVIDIA didn't need to compete anymore. They simply captured value from an inevitable they had positioned themselves for a decade earlier. Today, NVIDIA controls 80% of the AI chip market. Their data center business reached $39.1 billion in Q1 of fiscal year 2026. That's up 73% year over year, and that represents 89% of the company's total revenue. This is not dependent on any one company's success. This flows from the inevitable automation of global industry. Every factory, every warehouse, every logistics center, every hospital, every farm is going to automate over the next 2 decades. That is guaranteed. The only question is, which companies capture that value? And NVIDIA positioned itself at the infrastructure layer, which is exactly where you want to be. The third inevitable is one that most people see but few understand how to monetize: exponential data consumption and cloud infrastructure. Global data consumption grew 30% in 2020 compared to 2019, and it continues accelerating. Predictions suggest global data could exceed 180 zettabytes by 2025. That's up from 64.2 zettabytes in 2020. Video, gaming, Internet of Things, artificial intelligence applications, all of this is creating unlimited demand for cloud infrastructure and data processing. Jeff Bezos recognized this inevitable before almost anyone else. In the early 2000s, Amazon was an online retailer. But Bezos saw that data flowing through an organization and accessible by innovative teams was the competitive advantage of the future. Amazon Web Services didn't start as a core business. It started as infrastructure Amazon needed for itself. But Bezos recognized that if Amazon needed this infrastructure, every other company would need it too. AWS became the layer through which the internet operates. And here's the magic. It generates immense profit margins while making competitors dependent on Amazon's systems. Your competitors are literally paying you to run their infrastructure. That's a structural advantage that flows from an inevitable. Satya Nadella at Microsoft recognized the same inevitable and made one of the boldest strategic pivots in corporate history. He inherited a company that had lost the mobile operating system war to Apple and Google. Microsoft was seen as stagnant, legacy, irrelevant. Rather than fighting a competitive battle in mobile that Microsoft had already lost, Nadella redirected the entire company toward cloud computing, artificial intelligence, and hybrid infrastructure. He invested billions in Azure. He embraced open-source technologies, which was heresy for Microsoft at the time, and he positioned Microsoft not as a Windows competitor, but as the foundational layer of digital transformation. Azure's growth trajectory exceeded 80% of Fortune 500 companies' adoption within a decade, and that created switching costs so high that companies cannot leave even if they want to. You cannot rip out Azure infrastructure without destroying your entire digital ecosystem. This shift has generated returns that transform Microsoft from a stagnant software company into a platform for the inevitable digital transformation of global enterprise. Microsoft didn't need to beat AWS through competition. Both companies simply rode the inevitable wave of cloud computing. And both companies are worth over $1 trillion today because they positioned at the infrastructure layer of an inevitable. Jack Ma and Alibaba recognized the same inevitable in China's context. Alibaba is investing $52.7 billion over 3 years in AI and cloud infrastructure. That's not discretionary spending. That's betting on an inevitable that cannot be stopped. Alibaba expanded to 91 data centers across 29 regions worldwide, with plans to expand to Brazil, France, the Netherlands, Mexico, Japan, South Korea, Malaysia, and Dubai. Why? Because cloud infrastructure is not a business that might succeed. It's infrastructure that must exist for the modern economy to function. And whoever controls that infrastructure captures value from every business that builds on top of it. The fourth inevitable is one that most people experience every single day, but few recognize as an investment opportunity. The shrinking attention span and the rise of the attention economy. Here are the numbers. The average human attention span has declined from 75 seconds in 2012 to 47 seconds in 2023. That's nearly a 40% loss in a single decade. Attention has become the scarcest resource in the information economy, and scarcity creates value. The attention economy is now worth $853 billion in annual advertising expenditure, and it's growing. Mark Zuckerberg and Meta recognized this inevitable early. Facebook, Instagram, WhatsApp, these are not social networks, they are attention capture mechanisms. Zuckerberg understood that in a world of infinite information, attention becomes the limiting factor. Whoever captures attention captures value, and rather than fighting the inevitable decline in attention spans, Zuckerberg is doubling down. He's positioning Meta's next platform around AI-powered personal superintelligence. He's willing to spend $72 billion in 2025 alone to dominate the next inevitable. AI as the primary interface between humans and the world. That's not a company making a product. That's a company betting on an inevitable and positioning at the infrastructure layer. Influencer marketing emerged as a $250 billion industry riding this exact inevitable. Young people monetizing their ability to capture and hold attention in a world where attention is the scarcest commodity. Companies that recognize how to navigate the attention economy by capturing it quickly, personalizing without overload, and providing simplicity. They win by serving an inevitable, not by being better than competitors. The fifth inevitable is the broadest and perhaps the most powerful. Global digital transformation and the shift to data-driven decision-making. Digital transformation is not a project with an endpoint. It's an inevitable restructuring of every organization across every sector. Healthcare, manufacturing, finance, retail, logistics, agriculture, education, government. Companies that do not digitize their operations will eventually cease to exist. That's not hyperbole. That's structural economic reality. You either digitize or you die. Mukesh Ambani, one of the wealthiest people in Asia, recognized this inevitable in the context of India's retail sector. While traditional retail competitors focused on store-by-store competition, Ambani built Reliance Retail with digital transformation as its foundation. He launched JioMart, powered by 5G networks and cloud infrastructure, creating an omni-channel experience that brick-and-mortar competitors cannot replicate. Ambani is not beating competitors through retail innovation. He's riding the inevitable that digital plus retail equals the future structure of commerce. By controlling the digital infrastructure layer, he's positioned Reliance to capture value across the entire retail ecosystem, not just through stores, but through data, logistics, and financial services. He's not competing in retail. He's owning the infrastructure layer of the inevitable digitization of Indian commerce. Now here's the critical question. How do the wealthiest individuals identify these inevitables? What's the framework? What's the cognitive process that separates billionaires from everyone else? Because identifying inevitables requires a completely different way of thinking than typical investing. Rather than asking which company will win, successful investors ask what must happen. Then they identify the companies best positioned to serve that inevitable. Ray Dalio, founder of Bridgewater Associates, one of the largest hedge funds in the world, has systematized this approach. He argues that markets are driven by 4 determinants: growth, inflation, risk premiums, and discount rates. By understanding these building blocks through historical analogues, an investor can identify which sectors and regions will benefit from inevitable economic shifts. Dalio studied the rise and fall of global powers over centuries to understand the structural forces that drive long-term returns. The Dutch Empire, the British Empire, the American century. The patterns repeat. And by understanding those patterns, you can position ahead of the inevitable shifts that create and destroy trillions in wealth. This approach transcends short-term market noise and focuses on fundamental secular trends that play out over decades. Now let me walk you through the compounding math that explains why early positioning in inevitables generates such extraordinary returns. An initial investment of $10,000 growing at 8% annually doubles to approximately $20,000 in 9 years. Most people stop thinking there. But held for 36 years, that same $10,000 compounds to nearly $160,000. The power of compounding is exponential, not linear. For investors who positioned early in cloud infrastructure, between 2005 and 2010, in automation technologies between 2010 and 2015, or in AI infrastructure between 2015 and 2020, the compounding advantage is staggering. $100 growing at 9.8% compound return for 30 years becomes $1,652. A simple interest calculation over the same period would yield only $394. The difference between linear thinking and exponential thinking is the difference between comfortable and generationally wealthy. But here's what stops most people. Investing in inevitables requires a psychological discipline that most investors simply do not have. You must believe strongly enough in the inevitable to hold positions through multiple market cycles, recessions, and periods where the thesis appears to be failing. Charlie Munger emphasized this repeatedly. Investors must be philosophical about market fluctuations and maintain conviction in long-term fundamentals despite short-term noise. If you cannot hold through drawdowns with the conviction that fundamentals remain intact, Munger said, you deserve the mediocre result you will get. This is brutal but true. Most investors panic sell at the bottom. They chase performance at the top. They rotate in and out based on quarterly results, and they end up with mediocre returns despite being invested in companies riding inevitables. The returns from inevitables require patience, conviction, and willingness to be boring. While everyone else chases hot stocks and rotates sectors, investors betting on inevitables simply wait for compounding to work. Let me give you another real case that illustrates this perfectly. It's 2014. Satya Nadella has just become CEO of Microsoft. The stock is at $41 per share. The company is seen as a dinosaur. Cloud computing is dominated by Amazon. Mobile is dominated by Apple and Google. Analysts are writing Microsoft's obituary. But Nadella sees something different. He sees that every company on Earth is going to undergo digital transformation over the next 2 decades. That's an inevitable. And he sees that Microsoft, with its enterprise relationships and developer ecosystem, can position itself at the infrastructure layer of that transformation. He bets everything on Azure, on cloud, on AI, on hybrid infrastructure, and for the first few years, it looks like the thesis might be wrong. Azure is losing money. Amazon is dominating. Investors are skeptical, but Nadella holds conviction. By 2024, 10 years later, Microsoft stock is at $420 per share. That's a 10 times return in a decade, not from superior stock picking, from identifying an inevitable, positioning at the infrastructure layer, and having the discipline to wait while the thesis played out. Now, if you're watching this and thinking about how to apply these principles to your own wealth building, drop a comment right now with your biggest takeaway or your current challenge. I want to know what's stopping you from thinking in decades instead of quarters. I read every comment, and I use your feedback to shape the strategies I share in future videos. And if you haven't subscribed yet, what are you waiting for? This channel is about to drop strategies on sector-specific inevitable investing, on identifying the next wave of inevitables before they become obvious, and on building a portfolio designed for generational compounding. Don't miss it. Let me give you the actionable framework for building your inevitable portfolio. 6 principles that the wealthiest investors in the world follow religiously. Principle 1. Identify what cannot be stopped. Rather than asking which company will win, ask what must happen. Aging populations cannot be reversed. Automation will accelerate as workforces shrink. Data consumption will grow as connectivity expands. Attention scarcity will intensify. Digital transformation will encompass every industry. These are structural inevitables that no policy, no recession, no innovation can stop. Your job is to identify the trend that has the force of gravity behind it. Principle 2. Invest at the infrastructure layer. This is the most important lesson, and most investors miss it. The greatest returns flow to companies that provide the infrastructure layer of inevitables, not the consumer layer. NVIDIA wins not by selling AI models, but by providing the chips that make all AI possible. Microsoft wins not by building specific cloud applications, but by providing the cloud layer through which all applications run. Alibaba wins not by building e-commerce stores, but by providing the platform infrastructure. By investing at the infrastructure layer, you capture value from every player that builds on top of your layer. You're not betting on one application succeeding. You're betting that the entire category succeeds, and you win regardless of which specific applications dominate. Principle 3. Buy and hold through cycles. Inevitables compound only with time. The investor who positions in 1990 and holds through 3 recessions, multiple bear markets, and periods of stagnation will capture extraordinary returns. This requires discipline to avoid selling into panic and conviction, to hold through periods where the thesis seems to be breaking. Buffett's insurance companies have generated compounding returns for 60+ years because they held through every market cycle, every recession, every crisis. The wealth wasn't made by being smart during those crises. The wealth was made by not being stupid, by not panicking, by not selling. Principle 4. Recognize structural advantages as secular tailwinds. Once positioned in an inevitable, you benefit from tailwinds that never stop. An insurance company benefits from premium growth every year as the population ages and the economy grows. A cloud infrastructure provider benefits from data consumption growth every year as digitalization accelerates. These are not competitive advantages that must be defended through superior execution. These are structural advantages that flow from underlying trends. Your only job is to maintain quality and wait. The tide does the work for you. Principle 5. Think in decades, not quarters. The investment community obsesses over quarterly earnings, annual performance, short-term momentum. Investors betting on inevitables think in decades. Will this company benefit from aging populations for the next 30 years? Yes. Will NVIDIA benefit from AI infrastructure build-out for the next 20 years? Almost certainly. Will cloud providers benefit from digital transformation for the next 25 years? Definitively. By extending your time horizon to decades, you filter out short-term noise and focus on fundamental trends that compound forever. You stop reacting to earnings beats and misses. You stop caring about analyst upgrades and downgrades. You focus on the only question that matters. Is this inevitable still inevitable? Principle 6. Avoid reactivity and focus on fundamentals that don't change. The fundamental human need for healthcare does not change with interest rates. The fundamental requirement for electricity does not change with geopolitical shifts. The fundamental advantage of owning critical infrastructure does not change with market sentiment. By focusing on businesses that serve unchanging fundamentals, you position yourself to benefit from inevitable trends while everyone else reacts to noise. You become anti-fragile. Market volatility doesn't hurt you. It creates buying opportunities. Now let's address the risk question, because I know what you're thinking. Near zero risk? How can any investment have near zero risk? Here's the clarification. We're not talking about zero financial risk. Any investment carries financial risk. What we mean is this: structural risk approaches zero when you are betting on inevitable trends that cannot be stopped. A bet on a specific company has high risk. That company can fail, be disrupted, lose market share. A bet on an inevitable trend has low risk because even if specific companies fail, the trend persists and creates new winners. By diversifying across multiple players that benefit from the same inevitable, an investor dramatically reduces selection risk while maintaining exposure to the inevitable itself. Think about it this way. An investor who bet specifically on MySpace had high risk and lost everything. An investor who bet on the inevitable of social networking had lower risk because even though MySpace failed, Facebook captured the value, then Instagram, then TikTok. The inevitable didn't fail. Specific companies failed, but the inevitable persisted. This is why the richest investors diversify within inevitables rather than concentrating on single bets. They don't try to pick the one winner. They position across multiple players capturing value from the same inevitable. And they win regardless of which specific company dominates. Let me bring this all together with one final example that ties everything together. It's 1994. Jeff Bezos is working at a hedge fund in New York. He's 30 years old. He comes across a statistic that changes his life. Web usage is growing at 2,300% per year. He recognizes immediately that this is an inevitable. The internet is not a fad. It's not a trend that might happen. It's a fundamental restructuring of how human beings communicate, shop, learn, and work, and he sees that if he positions correctly, he can capture enormous value from this inevitable. He doesn't try to predict which specific use case will dominate. He doesn't try to pick winners. He picks a category, books, where the internet has obvious advantages over physical retail, infinite selection, lower prices, convenience, and he builds Amazon. But here's what separates Bezos from everyone else who saw the internet coming. He didn't stop at retail. As Amazon grew, he recognized another inevitable: data consumption and cloud infrastructure. Every company would need to digitize. Every company would need cloud computing. And Amazon had already built that infrastructure for itself. AWS launched in 2006. Today, it generates over $90 billion in annual revenue with profit margins that dwarf retail. Bezos didn't just ride one inevitable, he positioned at the infrastructure layer of multiple inevitables. And by doing that, he built one of the 5 largest companies on Earth. That's the ultimate principle. The fundamental separation between the wealthiest individuals and everyone else. Wealth is not built through superior stock picking, market timing, or competitive superiority. Wealth is built by identifying trends so powerful that they cannot be stopped, positioning at the infrastructure layer, and having the discipline to wait while compounding works. Aging populations will reshape healthcare, robotics, and finance for the next 50 years. Automation will accelerate for the next 30 years as workforces shrink and productivity demands grow. Data consumption will grow exponentially for the next 20 years as AI and Internet of Things proliferate. Attention scarcity will intensify indefinitely as information density increases. Digital transformation will continue for the next 25 years across every sector. These are not predictions based on hope. These are structural inevitables based on demographics, economics, and human nature. So here's what you do. Bet on what must happen. Position at the infrastructure layer. Invest early. And wait, this is how the richest people build generational wealth. This is the strategy of inevitable compounding. This is how you move from hoping for returns to engineering certainty. Before I let you go, remember what I said at the beginning. This channel is brand new and we're building something special here. A community of people who think differently about wealth. We're aiming for 100 subscribers, and I need you to be part of that foundation. If this video changed how you think about investing, hit that subscribe button. Help us get to 50 likes so I know this message is resonating. And drop a comment telling me where you're watching from and what your biggest takeaway was. I want to know if you're in New York or Singapore or Lagos or Sao Paulo, because the principles of inevitable compounding work everywhere. Wealth is being created right now by people who understand these principles, and I want you to be one of them. In the next video, I'm going to break down sector-specific strategies for positioning in each of these inevitables. Which healthcare companies are best positioned for the aging wave? Which automation players have the strongest moats? Which cloud infrastructure providers will dominate the next decade? the strategies the ultra-wealthy use to identify winners at the infrastructure layer before they become obvious. You're not going to want to miss it. Until then, think in decades, position in inevitables, and let compounding do the work. This is William Vanderbilt. Welcome to Premium Wealth Insights.